Evening. Welcome to the, what is becoming, I guess, a semi-annual Liquidity Risk Symposium. Tonight's title, I think, is an interesting one, especially given the events of today. Liquidity risk, either triggers or liquidity risk buffers, lessons from 2007. If you think about just today, in the sense the market reaction to, at 2:15 this afternoon, stock markets, in the US at least, the main indices fell almost 3%. Now, if you just look at that relative to the S&P 500 on a market capitalization basis, the market fell about $400 billion in the last hour and a half, hour and 45 minutes of trading. Why? Well, if you think about it, perversely, it would appear that kind of at the most basic level, the market's reaction was the Federal Reserve didn't think things were as bad as they did. So because the Federal Reserve didn't cut as much, didn't feel the need to do more than a 25 basis point cut in the federal funds rate and the discount rate, the market capitalization of the S&P 500 fell $400 billion. That's the kind of event we're dealing with right now in this. We're very lucky tonight to have two distinguished professors, Michael Johannes from Columbia University and Chester Spatt from Carnegie Mellon, two of the thought leaders in the area of liquidity risk, systemic risk. In the case of Chester, we also have the great benefit of the fact that he, until recently, was the chief economist at the Securities and Exchange Commission, and what I think is a lot more fun job, he's now on the Shadow Financial Regulatory Committee, which they just met, and hopefully we can get him to talk a little bit about that as part of this. I'm putting words in his mouth, which I told him I wouldn't do, but I think we've got a great two speakers here. I'm going to talk a little bit about, just at the beginning, to set the stage for this, and then we're going to end up with question and answer at the end. I think it should be, hopefully we'll have a lot of interaction as part of this. Yeah. If you go back to April, in April we had the last one of these symposiums. We talked about the relation, basically it was about the relationship, and it's almost more from an academic perspective, the relationship between systemic risk, liquidity risk, and market risk. Talked about how, things, they're similar, where they were interrelated, in some ways how they might be different. In a lot of ways, it was a great setup for this particular talk, because the events, which had just started to happen, there were starting to be some cracks in the mortgage market back at that point in time. But I don't think many people, some but very few, if they're really being honest, would have predicted the events that we've had starting in the summer and that continue to this day. When you're looking at these events, I pulled up a few of the slides from last time just to kind of set the perspective. What we're talking about here is lessons. We're trying to learn from the past, or in this case, learn from the present. Okay? In some sense, it's a forensic analysis of what went wrong, what happened, and in almost all cases, what were the faulty assumptions? What were the things that, after the fact, seemed maybe relatively obvious, but things that caused the triggers, that caused the events that we're seeing today. Some of the issues you deal with when you're talking about systemic risk, you're dealing with situations basically looking at the integrity of the financial system. It's really that simple in a lot of the cases what you're talking about. You're talking about things like these questions. These are questions that you probably have heard or at least thought about in the context of some of the things going on in the markets today. Will contracts or trades be honored? Will the markets be able to function in the way that we've become accustomed to them functioning? If they don't, what are the consequences? Will the markets be able to continue to provide capital needs of worthy issuers, both from a financial point of view and also from a manufacturing, industrial, corporate point of view? Again, coming back to this whole concept, if you look at this last point, basically, this is really a lot of what we're going to be dealing with. And if you look at and underlying a lot of the issues, both from a liquidity risk perspective, from a systemic risk perspective, what we're dealing with. We're dealing with assumptions that, after the fact, didn't seem to hold up. For an audience like this, a lot of you spend your whole day basically working on models. Effectively, you're trying to model prices, valuations, risks. Okay? In all of those models, they're all based on assumptions. Sometimes, in many cases, hopefully those assumptions are pretty good, and they'll hold in most situations. But they're never going to exactly get this right. There's too much uncertainty, too much basic volatility or risk or something that's missing in any of these models. They're always going to be assumptions. You have to think about the models as tools. And at times, and in some of the markets, particularly starting this summer and continuing to this day, those models can go terribly wrong. A model of determining the appropriate rating for a security. A model determining the appropriate price of a tranche in a structured finance product. Okay, a model that basically relies on some sort of correlation or some sort of prepayment. Those are the events, those are the assumptions that are going into these things that we're living with some of those assumptions right now in some of these markets. When you're looking at these events, in some ways, a liquidity event there is very simple. Okay? It's not simple to solve, but there are two things that almost always are going on. One is there's become some sort of increased uncertainty about fundamental valuation, a reason why people who yesterday might have bought on the smallest of price discrepancies no longer will. There's a reason that there's enough doubt or there's enough potential conviction that tomorrow I'll even be able to buy it cheaper than I can today. On the other hand, there's almost always somebody who's forced to sell. They're forced to sell at prices that may not make any sense to them. They certainly aren't the prices that were in the model. They're not the prices that they had the positions that marked yesterday. Maybe there's been no fundamental change between now and then, but that doesn't matter. It's a price that they can't get. They're forced to sell. All of a sudden, markets that were focusing on situations where the trading, you might have been quoting prices as 92 basis points over treasuries or over LIBOR. All of a sudden now it's being priced at $92, $87, $73. It's gone from a spread market to a price market, and it may not even be clearing at those prices. All of a sudden, the difference, there's some sort of a breakdown in the supply and demand curve. And that price settling mechanism that clears the markets. This year, one of the things I've talked about when I've done this in the past is how we tend to do a pretty good job of learning from our past mistakes. It's usually the one that we haven't thought of that catches up to us next time. I'm going to step back from that a little bit this time. Not that I think we haven't learned from some of our past lessons, but maybe we didn't learn enough, or we didn't realize how bad things could get on those assumptions. If you think about what's been going on in the credit fixed income market with the leverage strategies, the leverage investments today, there are a lot of similarities between what happened today, this summer, continues to happen as we speak, in 1998. If you look at what happened in the equity markets, the quantitative strategies, there's a lot of similarities to 1987. Okay? And both of those, I think, are important to understand as part of what's been going on in these events. Is the impact, one of the important questions whenever you're dealing with this from a regulatory perspective is the impact of this going to be permanent or transitory? Is it something that is a temporary effect, one that ultimately the markets will bounce back and we just have to, from an economic perspective, we just have to muddle our way through it? Or is it going to have some long-term negative impact on the overall economy? Is the impact going to be permanent or at least long-lasting? The answer to that question and a lot of these other questions is we don't know yet in this case, because it's still happening. Okay? And I made up this slide even before today's drop in the stock market. The fact is there's a lot of these issues that we're still living with today. Some of the cases be quietly behind the scenes. Other cases, you're seeing it coming out in some of the news stories. There certainly seems to be, or at least until 2:15 today, a disconnect, at least in the very recent times, between events in the credit markets, the fixed income markets, and those of the equity markets. I'll talk about a little of that in a minute. Okay. What has happened this year? Okay. I'm going to focus a little bit here on simply just looking at some spreads. And I'm going to focus predominantly on spreads, LIBOR spreads to treasuries, or the relationship between LIBOR, treasuries, and the federal funds target rate. Right now, it also happened in August, but even more so right now, LIBOR spreads, you look at it relative to 3-month, 1-month, whatever, relative to treasuries, they're at the widest levels I think we've ever had. The data I got went back to 1995, but they're wider than they were in 1998. They're wider than they were going into Y2K. They're wider than at any time in 2000, 2001, or 2002. Unprecedented spreads between LIBOR and treasuries. If you're looking for a trigger, in this case, there's a pretty good place to start trying to figure it out. Think about what LIBOR stands for. It's London Interbank Offer Rate. Keyword in there is bank. Okay? This is what's going on in the LIBOR market, and it's either the perceived risk premium required to transact interbank, or the required investment that banks want to take to lend. Shows you that there's something going on from a balance sheet perspective, from a desire to lend perspective. And that's rippling through the system. And that's a trigger that I think both of the speakers after me are going to talk a little bit about. But that is certainly something, capital adequacy, balance sheet issues are going to be very important components of looking at any triggers to what is going on here. If you look at the rates, again, over time, the three different curves, they basically moved roughly together over time when they had the same major drop. One interesting differential, if you look right here, all of a sudden, this is sort of the start of the summer, you had basically LIBOR rates haven't come down. In some cases, they even have gone up a little bit. Okay, and especially recently, they just went up. At the same time, treasuries have gone down. Okay, they've been going in opposite directions. That's why the spread between LIBOR and treasuries has gotten so wide. It's at unprecedented levels. Next slide. Just to put it in perspective, we're out here, it's still, even after today, it's still over 2. Okay. The highest in 1998 was a little over 1.5. Never got to that level even before Y2K and all the uncertainties associated with that. Never came close in any of these other times. Okay. You can come up with a lot of stories for this, but that's got to mean something from a liquidity perspective. You can look at the same way you can look at LIBOR relative to the Fed's funds rate, again, at historically very high levels. You can look at the Fed funds rate relative to the Treasury bill, and you can see that that's also at very high levels. A lot of this has been a flight to quality in the treasuries. A lot of it has been with the added liquidity with the cuts in the Fed funds rate. The treasuries have still gone down even further. So this spread between LIBOR and treasuries is coming both from a sticky and sometimes rising LIBOR and a sharp decline in the treasury rate. Again, that's a disconnect that we haven't seen, at least in the period where LIBOR has been an important, meaningful measure of the credit markets. We look at it relative to VIX. Okay, you see the same thing. They've been, in most cases, they've been relatively volatile, gone to relatively high levels at the same time. We had a little bit of that in the summer, but never anything close to the highs that we've seen back in 98, 2001, 2002. And even after today, when I did this slide, the VIX was a little below 21, which was not that far from its average over since 1995. Today it went up a little above 23. Okay? So again, instead of here, it's here. Okay? This number's still way up there. There's been a disconnect between, at least in the very recent times, between what people are perceiving as this uncertainty in the fixed income and the credit markets as there is in the equity markets. Skip the next couple. Skip that one. Okay. I'm not going to talk too much about this slide because I know both of the other speakers are going to talk about it, but one of the similarities you're dealing with between the other events, particularly 1998 and 2007, is in the credit markets there's been a reduced access to public markets. You look at a lot of the problems associated with CIVs, a lot of the problems associated with any of the people who were depending on asset-backed security financing, any of the CP markets. All of those markets effectively shut down in August, and in many cases they've slowly been coming back. It wasn't a case of the pricing mechanism adjusting. The markets basically shut down. Why? Because there was a lack of understanding or a lack of comfort that the people really knew what they were buying. I know that both of the speakers, I think, are going to talk about this. I think this is real important as part of this. A concern about the ratings. The IAFE had a panel discussion with Bob Merton and Myron Scholes a few weeks back. One of the things Bob talked about was that in the past, AAA ratings usually meant that you could kind of take those for granted. It wasn't where you put your best analysts, and it wasn't the best business use of that analyst's time to be studying AAA credits. That's no longer the case. That's a big change. I just saw a quote on a mortgage security from one of the managers that I work with that was basically a AAA security that had not even been put on watch for downgrade, was trading at 880 basis points over treasuries. It's a AAA security. Okay, that's, again, that before the events of this summer, you would have said that doesn't happen. That had to be a misprint. But it was a real price. This is, I think, an important lesson that we sort of learned in 1998, but we didn't learn it enough. And that is that with leverage providers, so in the repo market, if your counterparty is a lender, you're borrowing from XYZ Bank and you've bought mortgages with a haircut of 10%, which means they'll basically lend you $9 for every $1 of capital. You can buy, for $1 you can buy 10 mortgages, $10 worth of mortgages. Okay? One of the things that again, it used to be the case that you wanted to focus on, overnight repo really was overnight. Okay, it usually would get rolled, but it didn't always. Okay, but that wasn't the only problem that you had potentially, that not getting it rolled. One of the things is people realized you needed more cash, so all the managers went into this summer with a lot more free cash flow, a lot more unencumbered cash than you would have seen going into these events in 1998 or other times like that. Excess cash well beyond what anybody thought they would need. However, three things happened. One is the prices fell, so there were marks. Okay, for performance, that's a margin call. If you're at your borrowing capacity, okay, you have to come up with the money. If you're not, some of the severe market movements of the summer basically got you to your capacity real quickly, and you had to come up with cash. So that was one component that you had. Second was a lot of the lenders were changing the terms. They were changing the terms every time they rolled the financing. They were shortening the maturity. They may be changing the haircuts. There were some relatively drastic changes in the haircut. If you think about it, if I had a haircut of 10%, in other words, I could borrow $9 for $1 of equity, and they changed it to 20%, and there were changes which were much more dramatic than that. All of a sudden, I can borrow only $4 for every one. So if I was borrowing $9 before, and I want to keep the same investments, I got to come up with a lot more cash. Okay? That's two. The third, which is the part, even if you had all of those things set that you couldn't be, from a contractual point of view, you were termed out, you had fixed the haircuts, everything was else there. There's language in most of these agreements. There's language in most derivatives that gives typically the bank, the investment bank, but one side and counterparty, the right to set prices. Now if there's a well-traded, well-executed market in these securities, okay, they can't deviate from that too much. But if the securities don't trade, and these guys are both going to talk about that, I think, okay, how do you set it? There were cases this summer, continue to be cases, where no fundamental changes between yesterday and today. The broker, the lender comes back and says, your price is 20 points lower than it was yesterday. Okay, the joke I heard was basically people were going out and saying that, okay, they were asking the borrower, how much cash do you have? They told them that, and they said, okay, well, that's your margin call. That's being facetious, but that's effectively what was going on in some cases. The lender had the right to set the price. And by setting the price, they could make that adjustment, and it was a way of basically reducing the lending. Okay, it effectively was forcing margin calls. Now, if you think about one of the problems that you went through with this was, and one of the things where the regulators I do know got involved at some point, was there was a huge, a lot of the lenders also happened to own similar, or even in many cases, the same securities. Okay, they may have been telling the people that they were lending to that the price was 60, but on their books it was at 90. They got told they couldn't do that. Okay, and that's the type of thing that at least you're dealing with in this kind of situation. That kind of ripple, and that had a ripple effect through the system. If I've marked it down at 60, all of a sudden I got it on my books at 90, what does that mean? One of the things it means is that there's a lot of wiggle room in terms of how you price these things. If there's no transactions, okay, the models aren't necessarily going to help you decide what the price is as part of that. Next. Again, just quickly, what is the right price? If there's no trading, okay, if you have mark-to-market, that doesn't mean much if there's no trades. You have mark-to-matrix, it's similar things, but again, if I'm talking about AAA securities that have an 800-plus spread to treasuries, I don't think you're going to want to be able to have to price all AAA securities at 800 over. So again, this issue of ratings, this issue of what box to put this in, became all of a sudden a very difficult part of the process. It wasn't working. You look at it from mark to model. Again, you all of a sudden have to question almost all the assumptions that go in. If you're trying to get this thing to actually fit a price, what price are you going to try to fit? How do you deal with it? How do you deal with the differences in the correlation, differences in perceived default rates, differences in prepayment rates on these different securities, differences in the underlying potential value of real estate that lies behind the valuation of a mortgage. Okay, those are the issues that all of a sudden, basically, you're trying to deal with here, and from a pricing perspective, from a model perspective, what is the right price? When AAA securities right now have a bid-ask spread which is more than 20 points in many cases at prices where people would be willing to buy and willing to sell. Okay? You realize that that's not the normal functioning market that we've become used to deal with. Okay, quickly I want to talk a little bit about the quantitative side, 1987. Think about, again, one of the things we always talked about, portfolio insurance. Okay, it was one of all of this money that was in systematic momentum type of trading strategies. Okay, flowing into the market, basically trading together, relatively highly correlated. The market goes down, you sell. The market goes up, you buy. Relatively straightforward. Okay? The impact of that at that point in time, one is when all of a sudden the market started moving quickly, the trading systems couldn't handle it. The New York Stock Exchange almost broke on October 19th, 1987. It couldn't handle the volume. Okay? We did not appreciate the potential price impact of all these trend following strategies. We didn't understand, and in many cases I still think we don't understand, how much prices can be impacted by trading. Okay? We did not appreciate the potential correlation between the people doing portfolio insurance, the people who are doing systematic momentum trades, all of the sort of the first black boxes. And it turns out most of them were doing basically trades which, at least very roughly, were you sell the market when it goes down and you buy it when it goes up. Okay? That, especially in a time when the market's moving quickly, is going to be pretty highly correlated. Okay? We didn't appreciate how much capital was in all of these strategies. Okay? And we didn't appreciate how much volatilities could change, how much more volatile the markets could get in the short term than we had gotten used to. Okay. 2007. Okay. That was not a trading system problem, at least I would argue. The system's pretty much handled. Okay, we haven't, you're not going to blame this one on the New York Stock Exchange. You're not going to blame it on the ability to trade. Okay. But I don't think we appreciated, again, the potential price impact that those quantitative or systematic trading systems had on the prices. The trading, when you're buying things, when a lot of people are buying similar kinds of securities, it's going to move the market. We didn't appreciate the potential correlation between these different strategies. Okay? Now, a lot of people still claim that these quantitative strategies are not that highly correlated, except when they were. I think very few people appreciate how much aggregate capital had flowed into these strategies. There were several hundred billions of dollars in positions being traded in quantitative equity strategies. You can go through just 2 or 3 of the biggest names, and they had equity positions well over $200 or $300 billion. The amount of money was enormous. And it wasn't just the people that you've heard of, the big name hedge funds. It was the prop desks. It was a lot of the multi-strat hedge funds had quantitative portfolios that a lot of people didn't even know about. There was just a lot of money in these strategies. Okay? And again, we acted as if the volatility levels that we've seen in the past were going to continue to persist. One of the things I think is important to realize is it's difficult to distinguish between skill-based profits, the value of these systems identifying mispriced securities, and profits that really are coming from, in the short term, price impact. You move the price up. A lot of people are in the same strategies. They push the price up as well. If you bought early enough, you made some money. The problem is, what happens when you want, because the spreads have gotten too tight, or you need to sell? Think of what happened, again, in 1987, the U.S. stock market was up almost 40% through August, with almost no change in earnings. Earnings were flat for the first 8 months of the year, but the market was up 40%. Think of what that does to the PE ratios. A lot of that, probably after the fact, was the fact that people in a lot of these quantitative momentum systematic strategies were buying, and when the market went up, they bought more, and they bought more, and they bought more. They pushed it up. What happens when you want to reverse that? Well, you have to sell, and you have to sell more, and you have to sell more, and you have to sell more. So what you're doing is, again, effectively you're feeding the process. 2007, quantitative strategies generated, a lot of these guys had really good years going. They had 2006, 2007, very profitable years, very profitable. Okay, the spreads were, and it was coming basically, the spreads that they were targeting were tightening. They were tightening because they should have, or they were tightening because there's a lot of money flowing in and that will tighten them. Okay, there was also increasing leverage being used in these strategies. One was because the markets seemed low enough volatility that they could handle it, and people would lend it to them. The second was that if the spreads are getting narrower, to maintain the same kind of profits, you got to take on a little bit more risk. Now, all my systems, my VAR systems, my backward-looking trading systems were telling me that vol was pretty low and I could handle this. Okay, but again, what happens if the volatility picks up? What happens if it all starts to fall? What happens when the prices increase, or in the case of 2007, in some cases decrease, and they start to reverse? Forced trading. 1987, you had all the systematic trend followers. They had to trade. It was what they promised people they were going to do. If you're doing portfolio insurance, you have to sell on the way down. That's the product. Okay? There were margin calls among a lot of the funds. You had mutual fund redemptions going on. All this stuff fed on each other. And when the market started to turn, there was a flood of people wanting to sell. The market couldn't handle it. It fell dramatically. In 2007, you had reductions in proprietary capital being pulled, maybe because they needed it in other places, given some of the other events going on. You had margin calls going on at the hedge funds, or a lot of these people who were in these strategies because that had gone against them. You had people trying to take off positions just because the spreads had tightened. Okay, it was the natural thing. It fed on each other. Okay, you also had some redemptions going on at the time. All of those events basically led to a situation where there was a lot of people trying to, in this case, buy and sell at the same time. Now that sounds like that should be good. I got buyers and sellers. The problem was you had a lot of people trying to buy similar kind of securities and trying to sell similar kind of securities, and those were different. Okay? Biggest difference between 2007 and 1987, in 2007 most of these positions were long only. In 2007 you had longs and shorts, but they were basically the same kind of securities on one side or the other. And when you tried to unwind, you were buying some securities and selling others. There was a friend of mine looked at a portfolio for a quantitative manager in August. Okay. In this portfolio, there were probably 30 positions on the long side, 30 positions on the short side. I don't know what day it was exactly, but think of this, the probability of this happening normally. Every position on the long side was down that day, all 30. On the short side, every position that the manager was short was up on the same day. Okay, statistic. If this hadn't happened, I wouldn't believe it could. That's the type of thing which was happening. These positions, these underlying factors, were being traded in the same way across the securities, and they were having this kind of ripple effect. In October of 1987, the market was down dramatically. August of 2007, the stock markets were actually up. But you had quantitative funds losing 20+% in those months. Okay, you had portfolio insurance, you just didn't see it in the broad markets because you basically had longs and you had shorts. Okay, those are the two lessons that I think that are similar to what we've been dealing with in the past. You're dealing with this from a point of view of in the credit markets, where I think we are dealing with the potential of a systemic shock. In the equity markets, again, a lot of similarities to 1987, but it's probably been, especially because of the longs and the shorts, probably been more of a liquidity event and less of a systemic event. Anyway, I want to pass on. I took much too long here, but I want to pass this on. Next speaker is going to be Chester Spatt, professor from Carnegie Mellon, again, who just recently left the Securities and Exchange Commission, where he was the chief economist. And again, he's also he was very nice to come up. He's down in Washington. He was just at a Shadow Financial Regulatory Commission meeting where they've been focusing on some of these issues as well. Anyway, Chester.
Thanks very much, and thanks for the kind introduction. I appreciate the invitation to speak, and in fact, this is actually my first presentation. So I resigned from the SEC. This is actually my first presentation in New York post being at the SEC. And let me apologize, actually, right up front for the first typo in my slides, which is today's date. Hopefully, there won't be too many more. So I want to talk tonight about some issues related to liquidity, and I want to get at the questions about what brought on the crisis and what was different about this crisis from crises in the past, in a sort of a slightly different way, but I think in a way that you'll see overlaps a lot. So first I want to address a little bit the issue of systemic risk. I think the recent crisis, I think, and the turbulence in our marketplace over the last 6 months or so, I think does. I think the turbulence in our marketplace over the last 6 months or so illustrates some of the potential for systemic risk. And first, what do I mean by systemic risk? Well, basically, I see that as sort of the potential for correlated defaults across the economy. Now, many hedge fund investors, frankly, I like to sort of start out with the following observation, that many hedge fund investors often invest on the same side of a position. For example, often they've been long hedge fund investors, and indeed other sophisticated asset managers. They're often long the credit spread. And it raises sort of an interesting question. You know, those of us who are sort of students of capital markets, in particular students of market efficiency, kind of wonder why is it that the most sophisticated investors, why do they tend to be on the same side of positions? And I think of it as in part perhaps reflecting the commonalities in the training of these investors, commonalities in their expertise, commonalities in the tools that they use to analyze the markets. The issue of similarity in strategies, I think, really emerged quite vividly over the last several months, where one saw a variety of comments by hedge fund managers basically blaming their peers for some of the difficulties. And basically the argument, and one heard this in a variety of contexts, the argument was often that the reason that when the hedge funds tried to get out of particular positions that there were really big price impacts is that their peers were following similar strategies, and as their peers were simultaneously exiting, there were very large price impacts. You know, at some level, I find this sort of a remarkable perspective because, of course, the hedge funds and other institutional investors, they're embedded in a market equilibrium. And, you know, if there are truly mispriced strategies and opportunities, you'd expect lots of investors would be pursuing exactly those opportunities. So, in fact, this sort of blame, it really seems to me to just reflect basic equilibrium and market clearing types of considerations. Now, one other factor which I think also kind of cuts a little bit to kind of why there may be a lot of commonality in strategies. There's commonality in compensation. And I think the bearing of some of the kinds of risks that we see reflects the common incentive structure for many of these asset managers. Take the case of hedge funds. In many cases, the hedge fund might be compensated under the traditional 2 and 20 rule. Well, if managers are compensated under that sort of rule, they're going to tend to want to bear risk, and they're going to want to, in particular, tend to follow the strategies that make sense under 2 and 20. They're going to be sensible not only for one manager, but they're going to be sensible for others. So I think it's not kind of that surprising that there's a lot of commonality in strategies. And frankly, I think even arguably, the past policies of the Fed in the face of market turbulence even kind of arguably sort of reinforces the effect. I mean, you sort of see a day like today where, you know, arguably the Fed didn't cut interest rates as much as the market would have liked. Well, in a sense, you can think of this as it's kind of trying to provide encouragement. Obviously, it reflects kind of a competitive market process, but you can think of this as sort of trying to provide encouragement to the Fed to kind of listen to the markets and to kind of take the markets seriously. But there's a real important fundamental feedback effect. After all, if sophisticated investors think that if things kind of don't go that well, that the Fed is going to step in and cut interest rates dramatically, well, that kind of puts a floor into the strategies. And sort of some observers would sort of characterize that as sort of moral hazard. So exactly sort of the intervention of the Fed may in the future, current intervention of the Fed in the future may encourage additional risk bearing. So now who holds some of these risks? Well, many of the governors of the Federal Reserve, for example, I think in recent years have taken a lot of comfort from the fact that relatively less of the risk than historically has been borne by banks. Relatively more of the risk is borne directly by hedge funds, and in fact some of the senior leadership at the Fed will point to then what happened in the case where there have been liquidations. They point, for example, a lot of folks will point to Amaranth, and they'll sort of observe that how smoothly the liquidation of Amaranth went and didn't sort of bring down sort of integral players of our financial system. Well, of course, keep in mind that banks and prime brokers kind of provide a lot of the lending, provide a lot of the debt underlying hedge funds. And so depending upon the extent of a dislocation and the extent of shock to the system, the financial system isn't necessarily immune. Indeed, the exposures in our current structure are relatively less transparent than when they are directly held by banks. And indeed, just sort of step back and reflect upon our experiences with respect to the valuation of major financial institutions over the last several months. If you kind of roll the clock back to about September 1st or so, most observers of the marketplace basically sort of had the view that there were some big bombs out there, that there were a lot of hidden losses, and it just was a little bit unclear exactly which institutions had those losses. It's become a lot clearer, of course, over the last several months. But I think most observers, and lots of commentary, even at the level of the Financial Times and the Wall Street Journal, focused in on how it yet wasn't clear who was holding the losses, but people seemed to know that there were sort of pretty big losses out there. And sort of what this sort of reflects, I think, is that the change in the structure of our financial system has sort of made the bearing of the risk less transparent than in the past. Now, our recent difficulties started with high defaults in the adjustable rate subprime mortgages, but frankly, the difficulties then moved to the better mortgages, and in particular, the closing, to some degree, the closing and the shrinking of the jumbo market. I think this summer is sort of a case in point. Now, you might wonder, how would that sort of transmission come about? Well, so initially, investors sort of didn't want to hold these adjustable rate subprime loans, but they needed to adjust on sort of more liquid dimensions. So guess what? They made their adjustments on other parts of their portfolio, and then difficulties in one part of the space then transmit to other parts of the space. I view the lack of transparency or opacity as obviously an important source of systemic risk. And I think kind of an interesting question is, can the opacity of our system, can the lack of transparency of holdings, is there sort of a natural way to fix that? And I see that as sort of a complicated issue, because obviously, for parties to simply kind of reveal all their reveal up front their portfolios obviously would lead them greatly exposed to all kinds of attacks on their viability. But the uncertainty as to who's holding what exposures, in fact, means that counterparty risk is quite significant. And you then kind of layer on top of that the lack of reliable and verifiable prices for illiquid instruments, and that just reinforces the nature of the opacity. The changes in adverse selection and transparency potentially help drive some of the liquidity changes in our marketplace. And at the same time, then, these factors lead to a reluctance to sell instruments with the largest losses due to illiquidity. So the selling and the problems actually spill over to other assets. And this is sort of, I would argue, what happened this summer, but it's also precisely what happened in the case of LTCM. That is, some of the difficulties go from the more illiquid assets to the more liquid ones. And this is sort of exactly the story in the movement of the problems to the prime jumbo loan market. So as investors need to reduce their leverage, to the extent that they don't want to reduce their leverage by selling the most illiquid instruments because they view as completely unsatisfactory the pricing of those instruments, the difficulties then sort of spill over. And in fact, in some form, this then leads to the credit crunch and then the recent actions of the Fed to try to offset that. So you've got, in effect, transmission of liquidity problems across our markets and across not only our markets domestically, but indeed around the globe. So the issue of credit ratings I see as another potential source of systemic risk. Now, of course, what we observed this summer is that the role of credit ratings have sort of changed in our economy. We used to think of credit ratings as sort of rating the credit worthiness of an individual firm. But what we learned this summer is that, in fact, credit ratings are relevant at other levels too. In fact, now the arguably incorrect rating of applied to not a particular issuer, but to a whole class of financial instruments. And so you've got an entire asset class that basically winds up being misvalued rather than individual loans and sort of some particular slices of idiosyncratic risk. Now, of course, many participants in the marketplace weren't investing much in their own due diligence and relied very extensively on these ratings, and boy, were they surprised. But you can then see that the credit ratings and the difficulties in the ratings are potentially themselves a source of systemic risk. I would argue what we sort of learned here is that there's frankly not been enough decentralized due diligence, not enough due diligence on the part of individual investors, too much reliance on ratings, and in the face of these major blunders by the credit rating agencies, clearly this helped facilitate huge difficulties in our market. I should also point out that the notion of ratings seems to be completely different in the securitization space as compared to traditional issuers, and I think this has sort of led to a kind of a lot of confusion on the part of investors as to what the ratings of course mean. Well, as you know, I used to sort of have a regulatory role, so let me make just a few observations about regulatory issues, more from a global rather than domestic perspective. So I think the crisis that we've observed, and particularly as you saw the spillover of the crisis across the globe during the summer, I think really raises some interesting issues about regulatory coordination. Of course, many of the hedge funds follow global strategies. We also observe tremendous consolidation of platforms. A lot of the platforms are operating more globally in recent years. As I've already noted, systemic risk spills across our markets in the global economy. The subprime, the turbulence that started out domestically in the subprime space spread quite a bit. Now, of course, as economists, we're sort of trained to view risk sharing as a good thing, and broader risk sharing is a good thing. Indeed, as economists, we often we'll look at observations like what's called the home country bias, and we'll sort of think that agents would do better if they shared risks more broadly. Well, notice the tension. On the one hand, we think that broader risk sharing is a good thing, but at the same time, what broader risk sharing does is it leads to greater transmission of the shocks across our global marketplace. I think an interesting issue with respect to systemic risk and the regulatory response is to keep in mind that many of our financial institutions are multinational institutions. And from that perspective, suppose many of the customers of a financial institution are in one country, but the regulator of that institution is basically in another country. I think that raises an interesting issue. Sometimes what's happened in domestic contexts is that the regulator has stepped in to arguably bail out particular financial institutions. Now, putting aside the issue of whether bailouts are good public policy, notice that in the global context, the feasibility of such bailouts is frankly, I think, much more limited. Why? Well, because the question is who will pay? If the financial institution is being regulated by a regulator from one country, but most of the customers are in another country, the incentives to engage in a bailout are arguably much diminished. As I noted earlier, arguably interest rate cuts themselves can be viewed as bailing out those who follow very risky strategies, and indeed sort of some of the debate, not so much maybe the marketplace, I think, seems to strongly favor current cuts in rates, but I think some of the academic debate that's been ongoing in recent months about the action of the Fed has sort of honed in a bit on this sort of the moral hazard types of issues. And again, let me just emphasize that the subprime turbulence, I think, really illustrates that problems these days with our global system of risk sharing really are not confined to individual countries. So finally, I'd like to be sort of wrapping up the formal part of my presentation, more formal part of my presentation. I'd like to make a few observations about regulatory arbitrage. One of the things that I observed as a kind of as a sort of a regulator of sorts over the last several years is that regulations are often oriented to specific types of markets or specific types of investors. And I think this points to the awkward nature of our regulatory system. For example, suppose hypothetically, as I think they are in practice, cash markets are more heavily regulated than OTC derivatives, and that mutual funds are more heavily regulated than hedge funds, which again I think kind of corresponds to the market reality. Now, imagine that there's an introduction of some new regulations that the marketplace perceives as burdensome. You'd expect that the introduction of those new regulations would lead to some substitutions in the form of transactions, perhaps toward less regulated markets and/or toward less regulated investors. But in fact, these substitutions lead to a fundamental challenge to our old models of regulation. Why? Well, because to the extent that the transactions shift, in effect get channeled to less regulated venues, you can actually reduce the effective amount of regulation by imposing nominally more severe regulatory requirements. After all, if agents substitute transactions toward less regulated forms as a result of heightened regulation, you can get, in fact, the perverse effect that higher regulation actually leads to a less regulated set of transactions. And I see this as sort of posing a fundamental challenge to our old models of regulation. It illustrates really the importance of regulatory competition, because arguably from the perspective of many investors, it really doesn't matter that much where an instrument trades. And so you can think of regulatory competition as there's a lot of discipline created by regulatory competition, in effect because of the potential of investors to engage in regulatory arbitrage. And precisely the channeling of transactions toward less regulated forms, for example, perhaps moving transactions to hedge funds from mutual funds, will reduce the transparency of risk-bearing, which in turn can heighten systemic risk. So actions by regulators that seem to impose more severe constraints can certainly have the effect of making our system less regulated. Well, finally, let me just make so as Roy mentioned earlier, so now that I'm no longer at the SEC, so as I was leaving the SEC, I was asked to join the Shadow Financial Regulatory Committee. So now I sort of have a somewhat different perspective, and arguably I would say even maybe a broader perspective than previously. And our Shadow group meets quarterly, and met most recently Sunday and Monday in Washington. And all of our discussion, frankly, was very much focused on issues involving the subprime crisis. And I think the four statements we issued really reflected a lot of unease about aspects of the current policy environment. Our statement on the administration's foreclosure plan, for example, I think had a lot of concerns about the concept of intervention by the Treasury. At the same time, sort of wondering a little bit about what the impact of this intervention would be. Sort of some skepticism that there would be much impact, but also wondering why were the boundaries drawn in the way that they are. On the one hand, I think people in our group were probably pleased that the plan was narrowly crafted as opposed to broadly crafted, but then also recognizing that narrow crafting of policies can lead to lots of potential distortions as agents, borrowers in this case, maybe adjust to try to get themselves scoped in to the relief offered by the plan. Our statement on government, this shadow group has been historically very critical of the government-sponsored enterprises, Fannie Mae and Freddie Mac, this time in the statement in government-sponsored enterprises, observed that currently Countrywide Financial, a major player, is currently obtaining roughly $50 billion of financing through the Federal Home Loan Bank Board in its home area, and pointed out that this illustrates the potential risk to the FDIC and our system of deposit insurance. Indeed, in another form, as a consumer, I myself have observed that Countrywide has been out there offering very high interest rates on loans, encouraging borrowers to borrow up to the FDIC insurance limits. So I think this is sort of, again, illustrative of sort of a kink in our policy arena. We also, the group provided another statement about Basel II. It's been quite critical of the Basel II approach, concerned about perhaps excessive over-reliance on models, and especially over-reliance on credit ratings, and sort of views the recent crisis as pointing to some of the inadequacies in models, but especially in ratings. And I think the group also has a lot of concern about at an institutional level, at the orchestrated partnership of this thing called the MLIC, where BlackRock has been asked to sort of provide sort of independent pricing of some of these mortgage structures, and kind of concerned basically about whether there's sort of enough third-party pricing that will underlie that. All of the statements of this group the group is actually hosted through the American Enterprise Institute, and all four of the statements that the group put together are available through their website. But I thought that the common theme that underlied these statements was potentially the potential inadequacy, on the one hand, inadequacy of the current policy responses, and in particular, concern about not looking enough toward market prices and our pricing system. Well, let me stop at this point and turn the floor over to the next speaker.
Thank you, Chester. And how those things, some of the problems and some of the mispricing potential in these models. So this is very much in line with what he's been working on. Again, we have a great, it's been great to have both Chester and Michael here for this, and I think that Michael go.
Ready? Okay. So I want to give some thoughts on the the current liquidity crisis that we're going through, and in doing so, what I want to do is trail back and figure out how we got into this situation. And when we see how we got into it, it'll be sort of obvious where, once we figure out how we got into it, we can hopefully figure out how we're going to get out of it and how that path is going to look like. So the first thing I want to do is talk about a couple years ago when we were in the exact opposite situation. So if you think back to 2004, 2005, we were in the situation where we had too much money and too much liquidity. Okay, and I saw this from a finance professor's perspective from a number of different ways. So I was going to make a top 10 list of signs that there was too much liquidity, but I only got through 4. The first ones, many others have noticed this, there were many academics going to start hedge funds. So the phone was ringing off the hook, and you could earn the present discounted value of all future academic salaries in 1 year. The second one, which was even more insulting, was my MBA students were starting hedge funds while in school. So they would take a course on something, and they would come to your office and say, I have this strategy, what do you think? And you'd say, boy, that's about the stupidest thing I've ever heard. And they said, well, I and 2 other students have already raised $40 million for this. You think, well, maybe they're not so stupid, and it's in fact me that's so stupid. I got 2 interesting calls from alumni. So I've done a lot of work, as Roy said, on modeling volatility. I got calls from alumni who run hedge funds who were asking me where I could find volatility. So you're the expert on volatility. We would like to know where you can find that because there is none left. And then finally, unfortunately, the link doesn't work, but this actually struck me when I was watching the Super Bowl in 2005, that a large number of mortgage companies had advertisements during the Super Bowl. Normally it's Coca-Cola and other people. So if you have a chance to go to YouTube, type in AmeriQuest. So they had a bunch of really, really good commercials running, which was, all these together are sort of a sign we had too much liquidity, too much money floating around. So where did it come from? I would argue it came from the negative real rates in 2003 and 2004 we had in the US, and at the same time recall that Japan had interest rates at 0, Europe had interest rates very low also. And then when the Fed started raising rates, the liquidity didn't vanish. Okay? In particular, we kept hearing this quote from the Federal Reserve and Chairman Greenspan: "The committee believes that policy accommodation can be removed at a pace that is likely to be measured." Okay, which gave this hyper amount of predictability to people especially in the interest rate markets, regarding the rate at which short rates are going to go up. And we're going to see in a minute, back to what Roy said, when there's a lot of leverage in the system, the rate at which short rates can change is sort of the fundamental variable. And with the Fed signaling that accommodation can be removed at a pace that is likely to be measured, a lot of people took this as, we know the path going forward for a long, long period of time. Contributing to that was also this so-called global savings glut, that in 2005 we saw the highest savings rate around the whole world ever. Okay? Everybody wants to save. Everybody can't kind of save, but everybody wants to save, which means that there's a lot of people who want to invest. Okay, so the question is what to do with all this liquidity. I don't know where this quote came from, but I found it somewhere on the internet. What central banks giveth, Wall Street shall taketh. Okay, so what was done with this money? Well, commercial banks had a very easy time to make a lot of money. Okay, when you have deposits, many of them paying 0%, or LIBOR sitting at 1%, and 10-year treasuries are trading at 4 or 5%, and 30-year mortgages are at 5 or 6%, it's very easy money to be made. Okay, and what you saw was this big scramble for deposits. So I was just digging through some of the websites. The actual deposits at these big banks went up very rapidly, but noticeably Citi went up because there were no mergers or acquisitions there. JP Morgan, I think, had some mergers and acquisitions. One other thing I noticed was how fast new branches of banks were opened. Okay, Citibank was opening around 10% more new branches in the United States per year. And I noticed this while coming down here, I think, I don't know, what is 9th or 10th, you see how these North Fork Bank things have popped up. I have no idea where North Fork Bank comes from, but there's North Fork banks all over New York City now. Not that we didn't have enough with JP Morgan and Citibank and everyone else. And at the same time, long rates didn't go up. Okay, so there's all this money. Commercial banks absorbed a lot of it. Hedge funds absorbed even more of it. Okay, so hedge funds had huge inflows, and it was very easy time. It was a very easy time for their carry trade, sort of the quantitative versions of the term structure carry trade. So think of buying value stocks and shorting growth stocks. Value stocks have higher dividends than growth stocks, so they have a positive carry. Okay, there were also lots of versions of these in currency markets, and then as Chester mentioned, sort of long credit of any and all forms. So this picture to me sort of sums up what happened. So in 2006, we had the year which was sort of the search for yield. Okay, so towards the end of 2005 and through 2006, many of these easy carry trades had vanished. The term structure was flat. Okay, so borrowing money at short rates and investing at long rates didn't do much for you. Okay, so that was for banks. And then for quant equity, especially for quant equity funds, a lot of the historically very profitable trades became less profitable as a lot of these spreads narrowed. And you can see this picture here. So the blue line is deposits at Citibank, and the red line is their net interest margin. Okay, and you just see this clips down year after year after year as the term structure flattens out. You can imagine the exact same picture would hold for almost any hedge fund. Okay, assets under management doubled, tripled, went up by 10, 20-fold. Okay, and the things they were trading, the spreads fell. Okay, and so then the question is, how are these people going to manufacture higher returns for their investors? Okay, well, there's two easy ways of doing this. There's leverage, okay, and there's writing various forms of out-of-the-money puts, okay, which in some sense also has a lot of leverage in it, but I'm going to treat these distinctly. So what do we do with all this money? Well, so think of the SIVs that we've seen. What's the typical structure, or typical structure of some of them that I've seen? Well, these guys were issuing asset-backed commercial paper at LIBOR minus something, They were buying floating rate mortgages at LIBOR plus something, not big differences, 20, 50 basis points. Then you lever it 10 to 15 times. Boy, what a great way to manufacture excess returns. At the same time, as volatility fell and quant equity spreads fell, quant funds had to increase leverage dramatically. So some that I've spoken to had 2, 3, 4 times as much leverage in, say, 2006 or 2007 than they would have had in 2002. For others who couldn't do these things, they found very creative ways to write put options. Okay, put options on what? Well, maybe not S&P aggregate stock indices, but things like house prices, okay, or effectively liquidity. So if you looked at the bridge loans for the LBOs, a classic put option that the banks were writing. So there's a $5 billion LBO. You get 1% for providing 6 months of bridge loans. So that's a $50 million profit, okay, for taking this potentially massive amount of risk. Okay? Commercial backstop facilities for SIVs, and then also sort of any levels or many of these levels of these mortgage-backed or LBO-backed CDOs. So then in 2006 and 2007, we saw sort of the beginning of the end, which was sort of an orgy, and now we see the hangover. Okay, so a picture I found mysteriously from the Federal Reserve website was a picture of asset-backed commercial paper issuance, so the yellow line. And this is wandering around, and then all of a sudden you just see it takes off in 2006 and the first part of 2007. Interestingly, we're back down to here, not too far away from where we were before, and my guess is this number is going to come back down to here. And this whole area under here, right, is the funding for these SIVs and fundings for things that probably aren't going to exist anymore in the future, okay, because they weren't good ideas. Okay, so the asset-backed commercial paper was financing a lot of the mortgage CDOs, but also the LBO volume. So to give you a sense, I didn't realize how big it was. In 99 and 2000, we had about $100 billion in LBOs. In 2006, we had about $500 billion. And roughly in the first half of this year, we had $630 billion in LBOs. Okay? All of those needed lots of short-term financing, which was guaranteed by the banks, okay, for a very, very small fee. You can maybe, if you want, add in the investment banking fees. And in the situation when they can't roll this stuff over, it all comes to a grinding halt, and that's how the story ends. Okay, so in February, the market for mortgage-backed CDOs sort of stopped. At the same time, nobody was too concerned about it rolling over, and it rolled over. Eventually, it slowed down in the LBO market this spring and summer. Okay? And I would argue that the reason, in some sense, the trigger we saw was in May and June and July, all the investment banks and commercial banks taking a lot of these bridge loans onto their balance sheets effectively levered them up more than they wanted to be. Okay, so I want to talk briefly about a couple of things. What are the big problems? Who's to blame? What happened in '98? And what's the lesson? So what are the biggest problems? As Roy said, where are the biggest problems? You can see any markets that require a lot of leverage are the ones that are in the biggest or in the worst shape. So you can see this in long-short quant equity trades or in spread-based trades. Okay, and if you looked at, you saw Roy's pictures of short-term funding spreads. Today's movement in the stock market precisely tells us how important leverage is. Today, roughly $400 billion vanished. Okay, but nobody's going to have a heart attack over that. If you add up the forecasted losses in subprime mortgages, or in fact all the mortgages, it's about $400 billion. Okay, why is everyone panicking over $400 billion in losses when we just had that today? Right, and the reason is it's held by people who have way too much leverage. Okay, a $400 billion hit to very levered people is very different than a $400 billion hit to very dispersed owners of equity. Okay? And so you see these sort of ridiculous short-term funding spreads, but there's no reason they're not going to get more ridiculous. Okay, I saw that 2-year swap spreads today closed at, I think, 108 basis points, much bigger than they've ever been before. So I think on a macro sense, the big problem is that the shock absorbers in the financial system, all these financial intermediaries, have become shock magnifiers. Okay, and mostly the commercial banks, the investment banks, and Fannie Mae and Freddie Mac. And noticeably, the hedge funds are not the problem. Everybody 2 years ago, if they would have asked where the problem would be, it would be with hedge funds. Haven't heard a whisper really out of hedge funds. So there have been some big losses, but no sort of big problems coming out of them. So then, could it get worse before it gets better? It clearly could, especially if you start sniffing around at what the banks are currently holding. If they have to delever much more, it could be a real scary sight. And in particular, if the home price declines translate over to the commercial real estate market, we're going to see sort of equally severe problems. And then I want to just note that the crisis, unlike 87 or 98, I think, in my view, is a good old-fashioned credit bubble. There was too much money loaned to residential real estate markets, leveraged structure, financial vehicles, commercial banks, and private equity. Okay? And what we're going to have to see then is the unwinding of this. Okay, so first, who's to blame? I think the first person to blame is the banks themselves. Okay, so I have a couple of quotes. I'm sort of shocked that these quotes were actually out there, but the famous quote from Chuck Prince, who's no longer with us. So on July 9th, when the music stops in terms of liquidity, things will be complicated. But as long as the music is playing, you've got to get up and dance, and we're still dancing. Okay, this tells me that he knew exactly what could happen, right? But what can you do about it? You just sort of wait. Maybe he was waiting because he thought the Fed would come in on the horse and fix things. This one was a little bit even more shocking. So on August 2nd, we see a lot of people on the street who are scared. We're not scared. Our team has been through this before. Well, you really should have been scared because it was a lot worse, I think. I hope it was a lot worse than they anticipated. Okay, and in particular, there was a lot of bad forecasting. Okay, I think you can blame a lot of this on assumptions, and this goes to what Roy talked about, in mortgage valuation models, which assumed in the worst case scenario that house prices would be flat over the next 5 years. I was digging through old Bear Stearns and Lehman Brothers analyst reports, and CDOs and subprime debt is not in the least bit risky if house prices in aggregate go up 5% per year. So what the person defaults, the collateral is increasing every year. When house prices fall, your collateral is falling, and all of a sudden these things become very, very risky. And so this was one input into a lot of mortgage valuation models that people really didn't think could go down. Okay, now these people have already been punished. Okay, I think the people who've not been punished yet, and this is going to be a little bit unfair, but is the Federal Reserve. Okay, so I think the massive amount of liquidity that was created was caused by the Fed by holding rates too low. This is probably Chester's comment about academics criticizing the Fed. This is sort of what we do every day. So they held rates for too low for too long, creating too much liquidity and raising rates in too predictable a fashion. Okay, which in an optimal response to this, the banks took in a lot of money, hedge funds took in a lot of money, and also entered in trades that had a lot of leverage. But I also think there's another issue, and there was a really nice editorial in the Wall Street Journal by Henry Kaufman about this issue a couple weeks ago, which is there has to be more prudent regulation of the banking system. To me, the truly striking thing about this event that's occurred is there was no trigger. Okay? In 1998, we had Russia default. Okay, there's an actual event. Okay, you could say that we didn't think a nuclear power could default, but the event occurred. It's hard to find the event here, except for that the banks were sort of pigging out on the mortgage securitization and the LBOs. Okay, they just got too big, and then a few little glitches came along, and all of a sudden the whole machine grinds to a halt. Well, how can the whole banking system grind to a halt? Well, we now know the banks were doing a lot of stuff they probably shouldn't have been doing. Okay? In particular, a lot of these SIVs and these off-balance sheet risks associated with the SIVs and the LBOs. So I found this quote. There was a famous speech that Greenspan gave in 1997 on regulation. And he basically, if you read through it, it's the market is a much better regulator than the government, which in many cases is probably true. We see now one example where the market was not a very good regulator of the banks. Okay, and so he said, rapidly changing technology is rendering obsolete much of the old bank examination regime. Market stabilizing private regulatory forces should gradually displace many of the cumbersome, increasingly ineffective government structures. This is a likely outcome since governments, by their nature, cannot adjust sufficiently quickly to a changing environment, which too often veers in unforeseen directions. Okay, in this case, the problem is that I think, one, it wasn't completely unforeseen, but a little bit of prudent regulation, asking questions about what these guys had off their balance sheet, what were the risks in one of these states of the world, could have averted at least a fair bit of what happened. Okay, so then the question is, what's needed to fix it? So the first is we need trading-based price discovery. Okay, current equilibrium in a lot of these positions is zero trading and therefore zero marking to market. And I think a lot of people think until that when the Fed cuts, it'll fix this. But the Fed, although cutting rates will help leverage structures a little bit, it's not going to fundamentally change the price discovery process. I think we're going to, not only do we need, we're going to see a new regulatory framework, okay, which is going to get us out of this problem that we have this sort of financial crisis without any trigger. Okay, so I think the Federal Reserve or someone else needs better tools and a better system to monitor the banks and especially their off-balance sheet entities. And then, as other people have, as Chester mentioned, the rating agencies. But I also think there's a lot with delegated portfolio management. Okay, there should be more responsibility there. And the solution is clear. We need a lot less leverage and a lot more capital. And I don't think we've seen this part resolved yet. Okay, and this is really going to hurt. So many of the leveraged structures that we see, I think, are probably going to largely vanish. Okay, this includes special investment vehicles linked to a lot of the mortgages. A lot of the commercial banks need to shrink their balance sheet a lot. They grew very quickly because there was a lot of money and there was easy money for them to make. There's no longer easy money for them to make. And then structures that eke high returns out of low spreads need to die. We've seen many of these other ones die before. Think of on-the-run, off-the-run bond trades. Those are sort of gone. You can't buy off the runs and finance them with on-the-run and lever yourself up 25 times. And I think this also may include Fannie Freddie and much of the mortgage securitization world. And then we're also going to see some recapitalization. We've seen this. It started, and it's not a surprise that Citibank's recapitalization was the absolute bottom of the market in November, the day that was announced. So a few comparisons between 1998 and 2007. So questions and comparisons. So the external trigger in 98, there was Russian default. The shocking thing, again, about this one is there really was none. The culprits in 1998 were hedge funds and probably their prime brokers, the banks that allowed them to take too much leverage. And here it seems the culprit is these massive flows that were created by the banks and the bankers and the people who bought those. Again, we saw an exodus of academics to hedge funds, so that was another commonality between 98 and 2007. Importantly, did inflows predict hedge fund losses? And they absolutely did, both in 1997 and 98 and now. 97, 98, you saw massive inflows into fixed income relative value funds. Okay, and if you look at the last 2 years, massive inflows into long-short quant equity funds. Okay, now we're seeing the reversal of that. So in 98, one big difference was how price discovery occurred. When Russia defaulted, a lot of the price discovery was immediate. Okay, there were people that were so levered they had to dump securities. So you didn't have to worry about the Argentinian bonds or the Brazilian bonds or the Russian bonds. You saw prices on your screens and there were trading because there were such huge forced liquidations. And we really haven't seen much of this yet. It seems to me that a lot of the commercial banks people are recapitalizing, but they're sort of sitting, well, let's wait this one out. Well, everybody can't wait this one out. At some point, people are going to have to dump assets. Okay, the Fed reaction was the same. The regulatory impact, I think, is going to be very different. In 1998, there was no formal regulation of hedge funds, but the banks did the regulating themselves. They don't allow the hedge funds to take the leverage they used to. And I think this time around, we're going to see a lot of regulation of commercial banks and especially the mortgage market. Okay, and given how important the things that are going to be regulated, how important they are to the profit centers of the banks, this could have big implications on how they're valued going forward. And then I want to briefly talk about one risk management lesson which Roy always talks about, which you saw here and you saw here, and it's not clear to me people still really get this one, okay, which is volatility and correlation spikes. Okay, by spikes I mean rapid increases in these think of implied volatility, but you can take a model and use the model to compute volatilities for any asset, not necessarily from option implied. Okay, so we occasionally see these very massive spikes in volatility, so think all these sort of crisis periods. Okay, and then because volatility drives almost all spread products, okay, this sort of huge spike is incredibly important. And also, since volatility sort of determines leverage ratios in portfolios, it's also important. So I want to show you a picture of some research I was working on. So I got a call from a friend at a quant equity fund who said, how would I know if volatility spiked upwards, sort of in a discontinuous manner? So what you can do is you can write down a model that would allow for volatility to spike up. You can do some statistics on it, and then you can look at what you get out. And so I'm showing here a picture of two asset pricing factors. One's sort of the S&P 500, and the other one is the red one is the black one is the so-called momentum strategy, where you go long stocks that have done well and short stocks that have underperformed in the past. And what do you see? When you analyze these models, you do see some spikes. So here's a period last summer in July where momentum volatility spiked, stock market volatility also spiked. Okay, and then we see August this year, the volatility of these momentum strategies going from, say, 7% to 15% in 1 or 2 days. Okay? And you also see S&P volatility going up also. But then you see a period like this, and I think this is the real challenge for quantitative modeling. Okay, this is a period where S&P volatility went straight up last February, but momentum was completely unaffected. Okay, so I think you're sort of calibrating a model and you're saying, well, what's the worst case scenario? Well, if you're looking back only a short horizon, you say, hey, look, momentum's unaffected by these market movements. Okay, and this is why this summer, to what Rory was talking about a lot of these equity quant funds, they took such huge leverage. Portfolios like Momentum were great because when the market typically spiked, the volatility of the market spiked, Momentum was just sort of cruising along. Okay, and I think this is the fundamental problem is some of these spikes are highly correlated and some of them are uncorrelated. And I don't know quite yet the answer of how to figure out when one's going to occur or the other one's going to occur. But I think, to me at least, this is sort of one of the fundamental risk management problems of how to figure out when the assets you have are going to co-move. And when they co-move together, that's when the problems occur. So I think that's all I have. Thank you.
Thank you very much, Michael. We have time for a couple of questions before, and by the way, after the questions, there's a reception back in the back of the room, so you're all welcome to attend. But questions? Does that mean we had all the answers? Yes.
We constantly hear the phrase liquidity and illiquidity, but I've yet to see a quantitative measure. Is there one?
I mean, in the academic literature, there's about 500 of them. The problem is no one of them really captures. We all sort of intuitively know what we think it is, but it's hard to actually write it down.
Is there a useful?
I think there's many useful measures. I mean, Chester knows more about this than I do probably. Many measures that capture aspects of what we think liquidity or illiquidity is. I don't think there's any silver bullet.
Yeah, they're tools, just like everything else. They're the graph that I had up there with regard to just looking at the spread between LIBOR and treasuries. That's an imperfect measure of liquidity in one way. You look at any of these kind of spreads, you look at bid asks, all of these things. Again, there's no one right. Frankly, if you could get and always knew the bid ask, the real bid ask for any kind of size in a trade, that would, how that changed, that would be a good measure of liquidity. But you can never get that information. You only get to see the trades as they happen, and you might see a partial display of a bid ask. But, it's one of those things where illiquidity is something that you know when you see it, unfortunately. Yes. Yes. Yes.
I don't know. I would guess. I know what the factor volatilities for factors that people call size have been, and actually those have been quite stable this year. So my guess is the equally weighted volatility wouldn't have moved as much as a market cap weighted one, but I haven't actually done the calculation.
The other question is, this is for some of the earlier discussions. Basically, let's say regarding 87 or earlier, I mean, we had essentially the equivalent of either chartists or Reagan daughters that tend to look at as markets rise that things are getting expensive, so they'll sell. And similarly, as things are falling, they're saying it's cheap. Not that maybe it fundamentally isn't worth anything. I mean, but here, the quant strategy seems to be the actual opposite of that, and would feed that system, would act like a specialist in that system. So why does the quant model get blamed for that?
I would actually argue in 1987, a lot of the trading after the fact, when you look at it, really was the vast majority of the systematic trading was momentum-like trading, that it bought when the market was going up and it sold when the market was going down. And I think, just like anything else, if you have that phenomenon and there's more and more money having to buy or having to sell, that'll magnify the price impact. And I think that's what we've seen in the quantitative strategies. Just like in Michael's last graph, when you break out the factors, instead of looking at the indexes, if you look at, in August, the numbers on the equity market indices were up. But if you look at the returns to what, you know, they would call the factors driving the quantitative models, I guarantee you that those things, you know, there was a lot of money flowing in the same direction on those factors during that time period. You can't have that kind of trading otherwise.
Basically, in '87, I was at a shop that was doing long, short, and just strategy. In fact, up until that day of the crash, the mini crash, I mean, we have an automated proprietary trader, an active market automated specialist, literally markets operated by day of the crash. These specialists on the floor of the exchanges weren't open.
A lot of them went out of business.
Well, basically, because if they said that in fact, if they opened, they would have been bankrupt. If they were bankrupt, they had to tell the exchange, and they were covered. So here, to prevent that from happening, to protect themselves instead of the clients, they stayed closed.
Yeah, you had by far the biggest volume trading day up to that, you know, double anything in the past. And most of the trading, frankly, got done where people didn't know what the price was because the tape was delayed by over an hour.
And from the standpoint of the portfolio insurance, that I knew worked back then, as long as they didn't go to the derivatives market, because there wasn't disconnect between the derivatives market and the cash market. And that created a lot of
I was actually involved in that at the same time as well. What really was one of the major driving factors is whether or not it quote, worked. And by worked, I mean you preserved your capital. It wasn't, you paid for a very expensive option, but the way you preserved your capital was to basically move as quickly and aggressively as possible. And frankly, if you took your lead from the futures market and used that to set your price, when it was, you know, when you had an indication, you were selling as much and as possible and as fast as possible. Those are the people that basically made it through with their capital preserved.